Welcome back to Faceless Business School, where we break down complex accounting standards into simple, easy to understand concepts. In this lesson, we are diving into IAS 2, Inventories. Let's get started. By the end of the lesson, you'll be able to understand an overview of IAS 2, the objective of IAS 2, how to recognize inventories, how to measure inventories, the cost formulas allowed under IAS 2, and key disclosure requirements. Overview of IAS 2. IAS 2 Inventories contains the requirements on how to account for most types of inventory. The standard requires inventories to be measured at the lower of cost and net realizable value. A revised version of IAS 2 was issued in December 2003 and applies to annual periods beginning on or after January 1, 2005. Objective of IAS 2. The objective of IAS 2 is to prescribe the accounting treatment for inventories. The standard provides guidance for determining the cost of inventories and for subsequently recognizing an expense, including any write-downs to net realizable value. The standard also provides guidance on the cost formulas that are used to assign costs to inventories. Recognition of inventories. Inventories are recognized as assets when they are held for sale in the ordinary course of business or finished goods in the production process for sale in the ordinary course of business, work in progress, and materials and supplies that are consumed in production, raw materials. Exclusions from the scope of IAS 2. IAS 2 excludes certain inventories from its scope. These include work in progress arising under construction contracts, and that is dealt with in IAS 11. Financial instruments, that is the subject of IAS 39, and biological assets related to agricultural activities, which is the subject of IAS 41. Measurement of inventories. IAS 2 requires that inventories are to be stated at the lower of cost and net realizable value. The cost of inventory should include cost of purchase net of trade discount received. This cost of purchase should include taxes, transport cost, handling cost, and other costs associated with the purchase. Cost of conversion, including fixed and variable manufacturing overheads, and other costs incurred in bringing the inventories to their present location and condition. The cost of inventory should not include the following items: abnormal waste, storage costs, administrative overheads unrelated to production, selling costs, foreign exchange differences arising directly on the recent acquisition of inventories invoiced in a foreign currency, interest cost when inventories are purchased with deferred settlement terms. Net realizable value. The net realizable value is the estimated selling price in the ordinary course of business less the estimated cost of completion and the estimated cost necessary to make the sale. For example, if you think you can sell a cake for 20 Ghana cedis, but it will cost you 5 cedis to finish and sell it, the net realizable value is 15. Cost formulas. IAS 2 allows for several cost formulas to assign costs to inventories. First in, first out, or the FIFO method. This method assumes that the oldest inventory items are sold first. For example, if you stock milk, the milk that was delivered first gets sold first. First in, first out. The other cost formula approved under IAS 2 is the weighted average cost. Using this method, the cost of each item is determined from the weighted average of the cost of similar items at the beginning of a period and the cost of similar items purchased or produced during the period. For example, if you buy 10 apples at 1 cedi each and another 10 apples at 1 cedi 50 pesos each. The weighted average cost is 1 cedi 25 pesos per apple. We must note that the last in first out method, or the LIFO method, which was allowed prior to 2003, is no longer allowed. Write downs to net realizable value. Net realizable value is the estimated selling price in the ordinary course of business, less the estimated cost of completion and the estimated cost necessary to make the sale. Any write downs to net realizable value should be recognized as an expense in the period in which the write down occurs. Any reversal should be recognized in the income statement in the period in which the reversal occurs. Expense recognition. When inventories are sold and revenue is recognized, the carrying amount of those inventories is recognized as an expense, often called cost of goods sold. Any write-down to net realizable value and any inventory losses are also recognized as an expense when they occur. Disclosure requirement. IAS 2 requires the following information to be disclosed in the notes: accounting policy for inventories, the total carrying amount of inventories and the carrying amount in classifications appropriate to the entity, the amount of any write-down of inventories recognized as an expense, the amount of any reversal of any write-down that is recognized as a reduction in the amount of inventories recognized as an expense in the period. A summary of key takeaways. The objective of IAS 2 is to provide guidance on the accounting treatment for inventories. Recognition. Inventories are recognized as assets if they are held for sale in the production process or as materials and supplies. Measurement. According to IAS 2, inventory should be measured at the lower of cost and net realizable value. Approved cost formulas. The first in, first out, and weighted average costs are allowed. We must note and remember that the last in, first out method is not. Expense recognition. The carrying amount of inventories is recognized as an expense when sold. Disclosure requirements. Disclosure requirements for IAS 2 include accounting policies, the carrying amount of inventories, any write-downs, and then reversals. Understanding IAS 2 helps ensure accurate reporting of inventory in your financial statements. If you found this video helpful, give it a thumbs up and subscribe to our channel for more lessons. Thanks for watching, and we will see you next time.